Welcome, Dan. I'm here with Dan Jones from Campbell and Pound. Dan, thanks for joining me.
You're welcome.
So, Dan, I was looking through your resume, and I got to say I'm pretty impressed. But one thing really jumped off the page for me is Campbell and Pound is celebrating 80 years in business. I got to say, you look phenomenal.
I wish I could take credit for that, but
Yeah.
you know, there was my dad before me, and then a guy named Robert Pound before him, who's actually one of the founding members of the MLS system in North America.
Oh wow! I remember meeting your dad back in the mid '90s when I first got my license. Super nice guy, incredible sense of humor, and yeah, I could see. But looking at your resume, you've been an appraiser for 47 years. You're the a long time. Past provincial president of the Appraisal Institute of Canada from 2007, 2008. Provincial board director 11 years from 2002 to 2013. Yeah, I mean, it just reads so well. 6 years, National Board of Director, Ottawa Appraisal Institute of Canada, and most recently, 2017, the current Board of Director for BARIA, which is the Business Association of Real Estate Appraisals. Now, Dan, as much as the resume looks great, one of the things I love about you is that when this all came about, I know there's a lot of businesses that were like a deer in headlights, and they kind of just froze and didn't know what to do. You knew right away that the appraisal part of the way we do things just couldn't work. So I brought you on here today because I want to know what, like, you were very instrumental in changing the way things are done. And I just kind of want you to describe and touch on what's different now than, say, a month ago.
Well, there's a lot that's different now. I think, you know, going back 5 weeks when we first started hearing about COVID and it became an issue, we were basically doing verbal interviews with customers, asking them if they had been out of the country, and you know, have they got any symptoms of illness or what, those types of things. And of course, that was before we went into the isolation thing. I think they were allowing groups of 50 to gather at that time. Well, within 10 days, isolation became the norm. Not leaving your home became the norm. We had moved our entire staff into a remote situation, working out of the home, and we use Zoom video like this for our team meetings, and daily and weekly. We meet as well, but we do a lot of our policy changes and that type of thing on there.
So for the layperson out there, like, obviously you buy a home, typically need an appraisal. You refinance, you need an appraisal. What's different with the way you're doing things, or could someone expect, like, if I'm buying a house and I need to get an appraisal done, what should I be expecting?
Well, the one thing I'll say about appraisers and appraisal entrepreneurs in this province is they make a point of understanding the underwriting rules and regulations and the terms of reference that each lender uses. One lender might say that when we do all of our adjustments on our appraisals, they can't exceed 20%. Another one will say 25%. So what we do in BARIA, the Business Association, is we try to put that all together so we're all on the same page and we all understand it. One of the things that we realize is that there's a misunderstanding sometimes about what a drive-by appraisal is. What's the difference between a drive-by appraisal and a full appraisal with no inspection? Because we realized very quickly we can't start going into people's homes. We would put the homeowner at risk. We could put any of the other surrounding family members at risk. We could put our own appraisers at risk health-wise. So we want to follow the health authorities' rules and regulation and Bonnie Henry, and make sure that we're on the same page daily. And it changed by the day at that point. But I think what we have, you know, Marcus, we've got like a lot of sales, and the flow through from late February. We were in a very buoyant spring market, and it started to really percolate. But as you know, in real estate, you might buy something today and it doesn't complete until 6 weeks from now, or sometimes even 8 weeks, depending on where we're at. And so what we saw is a fairly busy March, at the same time that they're telling us that you know, a lot of people are out of jobs, the economy is taking a hit, and all those sort of negative things that were happening. we know the tsunami's coming. It just hasn't landed on shore yet, and it's starting to really hit now. Now that we're into April, we're five weeks past those points that I mentioned to you. And what we started to talk about is doing virtual inspections. So we have virtual meetings with your banker, with your mortgage broker. We now have virtual interior inspections. So the bank will send us out, or the credit union or the monoline lender, and we'll go to the property, physically get out of the car, walk around. We'll tell the homeowner we're going to be there at 2 o'clock. We do the rear yard inspection, take photos, take notes, side yard, front yard, and at the same time, we'll pick up the phone and we'll FaceTime with the owner who's on the inside of the home, and they'll do a walkthrough virtual tour video, so we can get a feel for the quality, for the inventory that's there, the flow of the floor plan, and then we'll ask them to take interior photographs. In fact, one of the things that we did during this whole COVID crisis is we have been working with our tech partner, which is in Canada here, and it's an inspection tool from ANOW, and we will send that to the homeowner by email. They'll open it, or it can also go by text. They'll open it and they will take the photographs for us and then upload that document back to us at the same time that we're already working on the appraisal. So that combined with, you've got video, virtual video, you've got still photos of the interior, and then you've got the physical inspection of the exterior of the property.
Right.
And the reason we did it that way is because if you order a drive-by, and this is where the big differences lie, the drive-by does not give you a final destination value. It gives you a range, like between X and Y. You know, a property's worth between $1 million and 1.5 million. That's not good enough for most underwriters. They don't want to see that. They want to know the remaining economic life of the building. So the appraiser will come to your house and look at your upgrades, and they'll pin a remaining economic life on the building, and they'll say this building has 40 years left. So if somebody's looking for an amortization, they will tie it to the remaining economic life, they being the underwriters. So for example, if you had only 10 years of remaining economic life left, which we call those bulldozer bait in our industry, that the house is ready to come down, the bank is not likely to give you a 25-year amortization period on the mortgage. They're probably going to match it up. All those things, they want to know what the land to building ratio is, the underwriters. That doesn't happen on a drive-by. Then there's the liability. Just based on human error, we carry $2 million worth of insurance, and every lender wants us to be insured. In case there's a mistake, they don't take a loss, and the homeowners don't take a loss, and you don't take a loss. So there's $2 million coverage on a full appraisal. There's only $50,000 on a drive-by. So the first thing we were hearing is, you know, when you say we're doing a full inspection with no
yeah, they're kind of relating it to, oh, why don't you just do a drive-by? What's the difference?
Why don't you just do a drive-by? Because they're different animals.
Yeah, no, and I get it. And I think the takeaway here is, you know, there's a very limited space probably where a drive-by is actually going to be used. I mean, for a typical purchase, refinance, the bank, even the bank themselves, they're not going to want to drive-by. So you can forget.
They do low loan to value, like a desktop, or they get an AVM, we call them automated valuation model, those types of things,
right,
like a land core.
So the next thing, Dan, and this is probably a super key important one, and I'm sure everybody would be interested to see what are you seeing out there? Like, obviously we haven't been going a long time, so there's not a lot of stats, but what's the market like in terms of dollar value? I send you in today versus I sent you in 2 months ago.
Right. Well, 2 months ago, still January, and you know, we traditionally always have that sort of Christmas hangover period that goes into January, but usually it picks up around that third month. And most realtors will tell you that our patterns kind of follow and blueprint that of a realtor quite often. You know, it'll slow down at Christmas, slow down the first couple of weeks in July when people go on the holidays. That was then and this is now. I mean, there's quite a bit of a difference in what happened. What we noticed is we were having a very stellar market, spring market starting to happen because there was a shortage of listings. I won't lie. There is not an overabundance of listings on the market. So we've got low supply, and we had really strong demand going into the spring market until this COVID-19 thing appeared. And by the time it appeared, it wasn't considered a big deal, like as I said, late in February. But as you know, as we moved forward, it was changing not only by the week, but by the day. And by the time we got to mid-March, the numbers changed considerably. There was a 75% reduction in the number of sales that took place in the Greater Vancouver Real Estate Board between the 16th of March and 31st, as compared to the first half of the month. That's big. And you know, what I always tell people, especially our underwriters, when we're defending our values, if they call and they ask questions, is, you know, we base everything on data and we do everything in the rear view mirror. So it's present day and historical data. That's how we look. What we don't do is estimate or forecast into the future, because I wouldn't be doing this job if I knew how to do that and was correct at it. What I do though is I look for red flags and amber lights moving ahead, like we all do in life. And we think there's a tidal wave coming, and we just don't think it's landed on shore yet. And what I mean by that is we're going to be short of data. There's going to be a very slim amount of data that appraisers will be able to use, and realtors, over the next, let's say, 90 to 180 days. 180 days converted is 6 months, and 90 days is 3 months. So
let me stop you for 1 minute, Dan. So on that note, let's just say your data is now very slim. So when you say you're anticipating this tidal wave, would that be because you're going to get pushback from the lenders? You're going to say, listen, we can't take the data that you have because it's too old, so we're not going to support this price? Or what are you insinuating in terms of where's the tsunami, or where's the tidal wave?
Well, I think what we've always had as a rule in by most of the underwriters is they don't like looking at anything over 90 days. If they have to, they'll look at 180 days in a normal kind of stabilized market. But they want to see current information so that there's less of an opportunity for change. And that if they're gonna lend a lot of money on this deal, they want to make sure that they're solid. That's going to be a little bit out the window moving forward when we see a huge reduction in sales. What we're not seeing, which is very similar to previous recessions and very different. When I say different, I mean in previous recessions, there'd be a lot of listings come onto the market. People, we've got to sell, the market's slowing down. And that would be an increase in supply. That's not happening. I mean, I can tell you the Vancouver numbers were 3.8 listings for every sale that's taking place. That's a 4-to-1, that's a 25% ratio. That means as a buyer, you know, you basically only can look at 4 listings before the property sells. And hence that causes in a normal market, probably multiple offers. But what's missing now because of COVID is the demand. And as soon as you take the demand away, everything goes soft, everything goes flat, and we get discounts in the market. Different from a previous recession where you had an imbalance in supply and demand. It's really just the one component. And that's why I believe when the market does come back and we get back to normality, whatever discounts the market is going to take over the next 3 to 6 months, I think it's going to recover very quickly.
Well, you know, I was listening to an economist the other day, and, you know, the thing about economists is there's always one that's right and one that's wrong, but they had a good point, and they said that this is like one of those huge snowstorms where you're just stuck inside and you can't move, yet everything's still in place when you go out, versus the tornado that comes and rips through everything, and you've got to rebuild, you got to do this. Basically everything's there. We just have to crank it back up again. So I don't disagree. I guess the billion trillion dollar question is, what are values going to be like? Because I'm sure the demand is going to be there for everything. I mean, the social demand is going to be huge. As soon as we get out of here, everyone's going to be wanting a huge party. I mean, it's crazy.
Yeah. So what we're doing right now, just so you know, so if we appraise your home tomorrow, we're going to be using the best sales that are available, and it's going to be going back 90 days roughly. So roughly to the start of the year. Anything that's sold from the start of the year to now, and we're going to place greater weight on the most current sales. So if something sold on March 25th or March 30th, we're probably really looking at that sale with more of a microscope, and that may sway where X to Y comes in. The value is always a range. After we make our adjustments for the differences in size and location and all the quality and all the size, zoning, all those things. We then adjust those sales and we say, okay, we've got a value range of X to Y. I'm putting more weight on the one that's right next door to the subject, right? Or putting more weight on the one that is waterfront if that's what I'm valuing. But in this case, I think time is going to be of the essence. So if one of those 3 sales is very recent, I'll probably, as an appraiser, place a greater weight on that one.
Right.
And so, that's about the best we can do, because it's really going to be up to your monoline lenders and your banks and your private lenders to say, okay, I've got this deal in front of me, I got this appraisal, but you know what? I don't think that anything's going to sell right now, because he's got sales here, but they are before COVID. So that's where the underwriters will make their decision.
And I guess that's going to be the big unknown. And I guess that kind of sways me to my last part, because I do have a lot of private deals that I do. And obviously with the banks tightening up and people losing their job, the banks aren't lending to the people that would have qualified a month or 2 months ago. So they're having to turn to that private side. What are you seeing from the lending end, from the private lender? Are they sort of changing or tightening up like the banks, or what are you seeing?
Well, I'm not going to mention any names, but I made a couple of phone calls knowing that I was going to be talking to you today, Mark. And I mean, one of the things that we talked about with the private lenders, and they're mostly mixed, the mortgage investment corporations, and they think that there's lots of business out there. They think there's lots of lending to do. The biggest issue they've got is liquidity in this type of a market. When fear strikes the market, it's very hard to convert that to cash, right? The market's going to be void of that for a little while. Apparently, they're getting lots of phone calls, and they're just calls from their investors. Is everything okay? How are you guys doing with my money? But nobody's pulling their money out. From the 2 that I called, they didn't have any fears of that whatsoever. That was not even an issue. They said right now they're not cutting back on their loan to values. They're 65% for the most part on regular refis, and I think on purchases they're going up to 75. But they said that remains to be seen if we get into a deeper
for sure
fear hole, or whatever you want to call it, as we move forward. They may change that. But as of today, business as usual, but working virtually. Right.
No, and that's great to know. And Dan, listen, I don't want to let it go too long here. Great information. What I'm going to do is I'll put the video up. I'll put the contact info for Campbell and Pound, because I'm sure there's a lot of people that may be interested in getting the appraisal. And like I say, 80 years in business and 47 years in appraisal, one of the largest appraisal companies in the Lower Mainland. They can't go wrong. So once again, thanks for joining me. Great information, and be safe out there.
Thanks for having me, Mark.
Okay, thanks, Dan.
Bye.